What if just one narrow waterway could shake the global economy, spike oil prices, crash stock markets, and disrupt supply chains across the world? Every single day, trillions of dollars worth of goods pass through a few critical maritime choke points, and among them, one route stands above the rest when it comes to global energy risk: the Strait of Hormuz. In this video, we'll break down the world's most important trade waterways, why they matter, which companies and industries depend on them, and what could happen if one of these strategic routes gets disrupted. And before we continue, if you haven't watched our silver investment video yet, you can click the card above to watch it. Also, don't forget to subscribe, turn on the notification bell, and leave a like because it really helps the channel grow. Let's start with the 5 most important maritime choke points in global trade: the Suez Canal, the Strait of Hormuz, the Panama Canal, the Strait of Malacca, and the Bab el-Mandeb Strait. These waterways are absolutely critical because a massive portion of global oil, gas, consumer goods, food products, and industrial materials move through them every single day. Even a temporary disruption in one of these routes can increase shipping costs, delay deliveries, raise inflation, and impact financial markets. The Strait of Hormuz alone handles roughly 20% of the world's oil supply. The Suez Canal connects Europe and Asia and plays a major role in container shipping. Meanwhile, the Strait of Malacca is one of the busiest trade routes in the world, connecting Asian economies with global markets. What makes these choke points so important is that there are often very limited alternatives. If one route becomes blocked or politically unstable, companies may be forced to reroute ships thousands of extra kilometers. That means higher fuel costs, slower deliveries, and pressure on the global economy. By the way, let me know in the comments which global topic you want us to analyze next, because I read your suggestions carefully. Now let's focus on the Suez Canal. This canal is one of the most strategically important trade routes on Earth because it connects Europe directly to Asia without forcing ships to travel around Africa. Every year, thousands of cargo ships pass through this narrow route, carrying energy products, electronics, industrial goods, and consumer products. Many people realized its importance during the Ever Given incident in 2021. When a single container ship became stuck in the canal, global trade experienced massive delays and billions of dollars in economic disruption. That event showed how fragile global supply chains can be. Modern economies rely heavily on efficiency and speed, and when one critical trade route stops functioning properly, the effects can spread across the entire world within days. This is why investors closely monitor geopolitical tensions and disruptions around major shipping routes, especially today, where supply chains are already under pressure from inflation, geopolitical competition, and economic uncertainty. So, which companies are most exposed to global shipping disruptions? Major shipping companies, logistics providers, railway operators, oil transport firms, commodity traders, and industrial manufacturers. Companies like Maersk, Zim, Union Pacific, Canadian National Railway, CSX, and large commodity trading firms can all be affected by disruptions in maritime trade routes. When shipping costs rise or delivery times increase, corporate profit margins can come under pressure. At the same time, some companies may temporarily benefit from higher freight prices or energy volatility. This creates both risks and opportunities for investors. That's why understanding macroeconomic infrastructure is becoming increasingly important in modern investing. Because sometimes the biggest market moves are caused not by company earnings, but by global logistics and geopolitical events. If you're enjoying this analysis so far, make sure to subscribe because we regularly break down global investment trends and geopolitical risks in simple language. Now we arrive at arguably the most important energy choke point in the world, the Strait of Hormuz. This narrow waterway connects the Persian Gulf to global energy markets. A massive portion of the world's oil and liquefied natural gas exports pass through this route every single day. Countries like Saudi Arabia, the United Arab Emirates, Kuwait, Iraq, and Iran all depend heavily on this strategic corridor. Because of its importance, the Strait of Hormuz is constantly monitored by governments, militaries, financial institutions, and energy markets. Even small geopolitical tensions in this region can cause immediate reactions in oil prices. And if a serious disruption ever occurred, the impact could spread rapidly through energy markets, inflation, transportation costs, and stock markets worldwide. This is one reason why energy security has become a central issue in global politics. Modern economies still rely heavily on stable energy flows. So, what happens if the Strait of Hormuz becomes seriously disrupted? The first likely reaction would be a rapid spike in oil prices. Global energy markets could panic because such a large percentage of oil exports move through this route. Higher oil prices would likely increase transportation costs, manufacturing costs, airline expenses, and inflation worldwide. Shipping companies might reroute vessels, increasing delays and logistical costs. Insurance premiums for maritime transport could also rise sharply. Financial markets would probably react with increased volatility. Energy stocks might surge, while sectors heavily dependent on fuel and transportation could face pressure. This is why investors pay close attention to geopolitical headlines related to the Middle East, because even regional tensions can sometimes trigger global economic reactions. The Strait of Hormuz is more than just a shipping route. It's a pressure point for the entire global economy. Oil markets, energy companies, shipping firms, defense industries, airlines, manufacturing businesses, and financial markets all react to developments in this region. That's why geopolitical stability matters so much for investors. Many people focus only on company fundamentals, but macroeconomic events and strategic infrastructure can sometimes move markets far more aggressively. Understanding these global systems gives investors a broader perspective on risk. And in uncertain economic environments, understanding risk can be just as valuable as finding opportunity. By the way, if you want more deep dive videos like this about global trade, commodities, geopolitics, and investing, make sure to subscribe and let me know in the comments what topic we should cover next. This content is for educational and informational purposes only and should not be considered financial or geopolitical advice. Global markets involve risk, uncertainty, and rapidly changing conditions. Always do your own research before making investment decisions. Thank you for watching, and remember, sometimes the most important forces moving financial markets are happening far beyond the stock chart itself.